Overtime, more hours, more money, less taxes? The One Big Beautiful Bill Act brings no tax on overtime, but not in the way most people think. Welcome to the Freedom Group channel. We try to simplify taxes and business decisions so that you guys can focus on growth. Freedom Group is made up of 3 companies that have served our community for over 20 years now. We help with taxes, accounting, insurance, financial planning, and real estate, and we support both your business and your personal needs. Let's clear up exactly what the OBBBA does for overtime pay. The One Big Beautiful Bill Act introduces a new temporary deduction for qualified overtime compensation, and it's for tax years 2025 through 2028. This provision is often described as or called no tax on overtime, but the legal mechanics and limitations are really important to understand for both the employers and the employees. The new Internal Revenue Code, Section 225, as was added by the OBBBA, it allows individual taxpayers to deduct from their gross income up to $12,500 or $25,000 for joint filers per year of qualified overtime compensation received and reported on what's called specified information returns. In other words, W-2s or 1099. This deduction is available to both employees and the self-employed, provided the overtime pay is required under Section 7 of the Fair Labor Standards Act, or the FLSA. That is the half portion of the time and a half pay for hours worked in excess of 40 hours per week. Here are some of the key features of this deduction. The deduction is going to be available whether or not the taxpayer itemizes the deductions or takes the standard. The deduction is phased out for taxpayers with modified adjusted gross income, or MAGI, over $150,000 for single filers and $300,000 for joint filers, reduced by $100 for each $1,000 that you go over the threshold. The deduction is only available if the taxpayer includes their social security number on the return, and if they're married, that they file jointly. The deduction is not available for overtime pay that is also considered qualified tips, as there's a separate OBBBA tip deduction for that. The deduction is only for qualified overtime compensation, not for all wages or for overtime that is not required by the FLSA. So what exactly does no tax on overtime mean? It does not mean that overtime pay is excluded from gross income or is not subject to withholding. Instead, that the taxpayer must include all of his or her wages, including the overtime, in their gross income, and the employer must withhold income tax like Social Security and Medicare and the federal withholding taxes. What happens is that the taxpayer then claims the deduction for qualified overtime compensation on their personal tax return, reducing their taxable income by the amount of the deduction up to the cap and subject to the phase-out. So in practice, overtime pay is still subject to payroll tax withholding, which is income tax, Social Security, and Medicare, at the time that it's paid. So you may not feel a difference right away. The taxpayer receives and will feel the benefit of deduction when they file their annual tax return come tax time, because it may result in getting a bigger refund or reduced balance due. The deduction reduces your taxable income, not the tax liability directly like a credit would. The actual tax savings is going to depend on the taxpayer's marginal tax rate. So overtime pay is not truly tax-free in the sense of being excluded from gross income or exempt from all taxes. Instead, the deduction is going to reduce the amount of income that is subject to tax up to the statutory limits. So let's take a look at an example. Let's say an employee earns $15,000 in qualified overtime pay in 2025. The maximum deduction is $12,500 for the single filer, so that remaining $2,500 to get to the $15,000 is not going to count towards the benefit. If the employee is in the 22% marginal tax bracket, the deduction reduces their tax liability by $2,750. That would be $12,500 times the 22%, not the full $12,500. Again, Social Security and Medicare taxes still apply to all wages, including the overtime, and are not affected by the deduction, and state income tax treatment may differ from state to state, as this deduction is a federal provision. So here are some things to consider as far as the reporting and compliance aspect. Employers and payers are required to report the amount of qualified overtime compensation on information returns. Remember, that's the W-2 or the 1099. This is very important. The IRS is directed to issue guidance and provide transitional relief for the first year of implementation, since it's all so new and this was just passed this July 2025. In other words, the IRS is not going to go crazy issuing penalties the first year, since they know it takes time to make the necessary changes and implement them. Make note that the deduction is not available for overtime pay received in a SSTB, or a specified service, trade, or business, as they are defined in IRC 199-AD2. Married individuals must file jointly to claim the deduction, and the deduction is temporary. It's only available for tax years 2025 through 2028 unless it gets extended. So what does qualified overtime mean? The definition as used in the OBBBA and the new Internal Revenue Code 225 is as follows. Qualified overtime compensation refers to overtime compensation paid to an individual that is required under Section 7 of the Fair Labor Standards Act of 1938, and that is in excess of the regular rate as used in that section at which the individual is employed. In other words, it is the portion of pay that represents the premium paid for overtime work above the employee's standard hourly wage, as mandated by the FLSA. The definition specifically excludes any qualified tip as defined in Section 224D from being considered qualified overtime compensation. This means that the tips, even if they were received for overtime hours, do not count as qualified overtime compensation for the purposes of the deduction under the new Internal Revenue Code 225. The deduction for qualified overtime compensation is only available for the amount that is both received during the taxable year and is included on the statements furnished to the individual pursuant to Section 6041D4 or 6051A19, which are the W-2s and 1099s. In other words, this means that the overtime pay must be properly reported on the relevant tax forms to be eligible for the deduction. The deduction is also subject to additional requirements, such as the taxpayer including their Social Security number on the return, and if they're married, like I said before, they have to file a joint return to claim the deduction. Now, what does that mean for your actual paycheck? Because it's a deduction, the real tax benefit reduces your federal taxable income when you file the taxes after the year is over. If you don't make any changes to your W-4, the federal withholding is going to stay the same. But since your taxable income will be lowered by the deduction, you could get the benefit as a refund when you file on your return, or you can update your W-4 and lower your withholding so you see more of the money in each pay period instead of receiving it in a refund or having it potentially reduce your tax liability. Side note, the W-4 is the form that you fill out to give to your employer, and that determines how much money is taken out in federal withholding. Social Security and Medicare are set percentages, but the federal withholding is based on how many people are in your household, if you have other income. Form W-4 helps you identify these other sources of income and potentially determine how much you will be withheld. You could even include to have an extra amount withheld if you know that your tax liability will be high and you want to get a better cushion for it. So if you want to, you can adjust your W-4, and that's going to reduce how much is taken out of your check each week, knowing that this deduction is going to lower your taxable income at the end. However, if you lower it too much, you could end up owing. So that's the caveat. Now back to the topic. If you own a business, here's what you need to think about. You're gonna need to track which overtime amounts qualify and possibly update your payroll reporting. It may be a good idea to explain to the employees how the withholding might look different or might not, because the deduction comes into play on their personal taxes. Talk to your payroll provider and your tax advisor. Preparation always prevents surprises. Now, there are important limits, of course. If you earn too much, the deduction is gonna phase out. So the phase out of the deduction begins when the taxpayer's modified adjusted gross income, or the MAGI, exceeds $150,000 for single filers and all other filers other than joint returns, or $300,000 for joint returns. The deduction is reduced by $100 for each $1,000 or fraction thereof by which the taxpayer's MAGI goes over the applicable threshold. So what's MAGI and how do you calculate it? I'm glad you asked. MAGI is defined differently depending on what deduction or credit one is talking about. But according to the OBBBA's statutory language, as summarized, MAGI for this purpose is the adjusted gross income, or the AGI, plus certain gross income items that are excluded from AGI, specifically foreign earned income, foreign housing allowance, Guam sourced income, American Samoa source income, North Mariana Islands source income, Puerto Rico source income. So the OBBBA adds back those excluded foreign or territorial income items to the AGI to get to the MAGI used in determining the phase out. After determining the maximum allowable deduction, which is up to $12,500 for single filers and $25,000 for joint filers, the deduction is reduced as follows. Calculate the amount by which MAGI exceeds the threshold, either $150,000 or the $300,000. Divide this excess by $1,000, rounding up to the next whole number if there's any remainder. Multiply the result by $100 and subtract this amount from the otherwise allowable deduction, but not below zero. All right, so let's show you some numbers. Let's say that you have a single filer and they have a qualified overtime compensation of $12,500. Their MAGI is $170, so it's over the threshold, okay? So you're gonna subtract the $170 from the threshold of $150, and you have $20,000 that remain. $20,000 divided by 1,000 is 20. So you multiply the 20 times 100, and that's $2,000. So we look at the allowable deduction, $12,500, subtract the $2,000, and you're left with $10,500. Let's look at an example in a joint return. So say the qualified overtime compensation is $25,000, but their MAGI is $350,000. So the excess over the threshold is $50,000 because you take the $350 minus the $300. $50,000 divided by 1,000 is 50. 50 times 100 is 5,000. So the allowable deduction is the $25,000 minus the $5,000, leaving you at $20,000. This is a temporary law for now. That means it's essential to plan, but also watch out for updates and the IRS guidance on implementation. So here are 3 practical steps to take now. 1, talk to your payroll vendor. Make sure that they know the new rules and can tag qualified overtime correctly. 2, communicate to the staff. Teach the employees that a tax deduction may not instantly change their take-home pay unless withholding is adjusted. Number 3, consult with a tax pro because things can get a little confusing. Bottom line, the OBBBA provides limited federal deduction on certain overtime pay, not a blanket no tax exemption. It's a helpful change for many workers, but it comes with caps, definitions, and implementation details. Stay informed, plan ahead, and get professional help so you can maximize the benefit while staying compliant. Thanks for watching. Please subscribe and hit the notification bell if you haven't already, and practical tips will be coming your way every week. If you found this helpful and you want to keep learning, click on the video on your screen and I'll see you there. God bless you.